All right, I have a take that I need to say, and it is something that's come across my comment section for the past, I want to say, month. And it is the opportunity of day trading futures. I personally believe that trading option contracts on the S&P 500 is psychologically healthier and more profitable than day trading futures, specifically NQ futures, and here's why. My comment section for the past month has been flooded with the inquiry of day trading futures. Noah, your model would be better on futures. And those comments a lot of the times come up when I take a trade on options and it was unprofitable, even though I was correct in my decision making. My decision making for the model to predict that the S&P 500 is going to go down or up in the first 2 hours may be correct, but the option contracts weren't profitable. And why is that? It's this thing called decay, theta. In option contracts, especially trading 0 day till expiration option contracts, those contracts will lose value no matter what over time if nothing happens on the underlying stock. So if you're wrong, you're very wrong. And if you're right, you need to be right a lot in order to actually pull a lot of profit. In futures contracts, you don't have a time decay. There actually is no time decay. You can hold on to your contract for as long as you fiscally can. And emphasis on that point, as long as you fiscally can. And it goes into the fundamentals of exactly what the trading is for both. So I'm going to start with options because it's something that most of my viewers know about and something that a lot of viewers actually don't know about. Option contracts, and we're going to use the S&P 500 for example, the SPY, is a contract that you can buy and sell, but there's also an expiration date to this contract. That expiration date quite literally expires it. It liquidates it. It is worth nothing if it expires. There's different expiration dates that you can use that inherently change how risky the contracts are, but also change how much money you can make off them. For this example, we're going to use 0 day to expiration S&P 500 SPY option contracts. You can buy that contract for $30, let's say. That's usually going to be around 4 to 5 strikes outside the money. You can buy closer to in the money contracts for $60, $90, $100, increasing as far as you want and decreasing as far as you want. When you buy that contract, you have until end of market day to exit that contract or else it's going to be worth nothing. It's as simple as that. And I've preached this many times, but the most you can lose on one of these contracts is what you bought it for. And that is where your risk comes from. The amount of risk that you put into every single trade is essentially what you buy the contract for. If you have a $1,000 account and you want to risk only 1%, you buy a $10 contract. Same with 3%, same with, 50%, blah, 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 blah. You buy that contract. Let's say you have $1,000 in your account. You want to trade 3%, you buy a $30 contract. On that $30 contract, let's say you lose and you're bad and you're wrong. You will lose 70%, 50%. At the most you lose 100%. That's it. You lose $30. It's fine. You lost $30. You end up not making anything on the whole entire day. It is what it is. Now I'm gonna cut it right there and we're gonna go into futures. Now I understand what you're gonna say about this. You're gonna mention stop losses. I'll get to that. Chill out. When you are trading futures, you are trading on the NQ. You can trade mini contracts, you can trade micro contracts, or you can trade ES contracts, all changing on the payouts per point. On minis, it's $20 per point. On micros, it's $2. And on ES, it's $50. And so when you enter these contracts at, the price of the underlying position, which is NQ, it's very similar to Forex in that you can stay in that position as long as you want. There is no time decay at all, at least if you're financially able to afford it. When you enter futures trading, you're not buying an individual contract. You're entering an agreement with the exchange of a position. And so what's the floor of your losses? Okay, everyone knows their win rate and everyone can get a higher win rate in anything they do. What is happening if you lose? Well, there's only 3 ways to exit a futures contract. It is manual exit, where you quite literally just click the exit button and the close button. There is a stop loss, where obviously you set a stop loss and you exit the trade at that stop loss, or you enter this thing called a margin call. And this happens when the loss on a trade puts your account value below the amount of margin it has. The exchange and the broker forces liquidation of all contracts and you quite literally blow your account. That's right. Whatever your funded account was, whatever your cash account was, it went to 0. All in one trade. Now, let's be real here. We all need a stop loss. I feel like anyone that listening to this video or watching this video needs to hear this. If you're gonna trade futures, which I'm not saying don't trade futures, you can trade futures if it's working for you. If you're profitable with trading futures, do it. And I know if you're profitable, you're probably using a stop loss. Use a dang stop loss if you're trading futures. But here's the thing. I've watched many YouTube videos on stop losses. I've heard so many different examples and solutions as to where to put your stop loss. Should you just do it on a risk to reward ratio for your target? Should you do it on a supply and demand level? Should you do it on a fair value gap or whatever they want to call it? You can do that. That's perfectly fine. Here's another thing. You can change your stop loss. And essentially, if you're down in a trade but it hasn't hit your stop loss, you can drop your stop loss even farther than it can be and end up losing even more. Okay, what I'm trying to get at here, if you don't understand this, is that the losing aspect of options is automatic and it's safer. It's automatically safer because the risk impaired on your trading is done at the purchasing power, not purchasing power, as it's done at the purchasing phase of the trade. On futures, the risk is done in the stop loss form of the trade. That requires discipline, and that requires knowledge, and that requires more attention. Here's the thing. Anyone that wants to get into trading knows this, is that day trading is not something that you want to do laborious hours of work on. There's a reason why you sat in front of a computer and chose to make money clicking buttons than instead of flipping patties, serving tables, or going to a construction site. Everyone trades differently. Profitable traders are seen in every single facet of trading, whether it be Forex, futures, options, shares outright, gambling, etc. Bottom line is, I think options trading, as much as it is not as flattering and it is not as glamorous as futures is, it is something that works for me, and I am currently profitable. Emphasis on currently. Here's the thing. If I was profitable enough to establish myself as profitable, I wouldn't be making YouTube videos. I'd be living in the middle of tropical paradise, reaping the rewards of S&P 500 greatness. But that's not me yet. So I hope you enjoyed this video. Hope you enjoyed my yap session. Catch you guys in the next video. Follow my TikToks and Instagrams for trade recaps. Deuces.